Introduction to credit repair business. The credit repair industry offers significant opportunities for entrepreneurs to help individuals improve their financial standing. This course provides a comprehensive guide to establishing and managing a successful credit repair business. It covers everything from understanding credit fundamentals to advanced dispute strategies and legal compliance. Aspiring business owners will learn how to navigate the complexities of credit reporting and effectively assist clients in achieving their financial goals. The demand for credit repair services continues to grow as more consumers seek to improve their credit profiles. This diploma program equips you with the knowledge and tools necessary to thrive in this specialized field. It emphasizes both the technical aspects and the client-facing skills required for success. A credit repair business focuses on identifying and disputing inaccurate, incomplete, or unverifiable information on consumers' credit reports. This process aims to improve a client's credit score, thereby opening doors to better financial opportunities. Understanding the regulatory landscape, particularly federal laws like the FCRA and FCRA, is paramount for ethical and legal operation. Building a business on a foundation of integrity and expertise ensures long-term client trust and sustainable growth. This introductory section sets the stage for the detailed modules that follow, outlining the scope and importance of the credit repair profession. Understanding credit and credit scores. Credit represents an individual's ability to borrow money or access goods and services with the promise of future repayment. It is a fundamental component of personal finance, impacting everything from loan approvals to housing applications. A credit score is a numerical representation of this creditworthiness, calculated based on various factors in a credit report. Lenders use these scores to assess risk, determining interest rates and eligibility for financial products. Understanding how credit works and how scores are calculated is crucial for anyone involved in credit repair. This foundational knowledge empowers you to effectively guide clients through their credit journey. It forms the bedrock of all subsequent credit repair strategies. Credit reports compile an individual's financial history, including payment history, amounts owed, length of credit history, new credit, and credit mix. Each of the three major credit bureaus, Equifax, Experian, and TransUnion, maintains its own version of a consumer's credit report. Credit scores, such as FICO and VantageScore, analyze this data to produce a three-digit number. Higher scores indicate lower risk to lenders, leading to more favorable terms. Educating clients on these components helps them understand the impact of their financial decisions. This understanding is vital for both repair and long-term credit health. The importance of good credit. Good credit is more than just a number. It is a gateway to financial opportunities and stability. A strong credit score can unlock lower interest rates on mortgages, auto loans, and credit cards, saving consumers thousands of dollars over time. It also facilitates easier approval for rental applications, utility services, and even some employment opportunities, as many employers review credit as part of their background checks. Furthermore, good credit can provide peace of mind and financial flexibility, allowing individuals to pursue their goals without unnecessary financial hurdles. Educating clients on these benefits is a key aspect of a credit repair business. This knowledge motivates clients to engage fully in the repair process. Beyond tangible financial benefits, good credit contributes significantly to an individual's overall financial well-being and confidence. It reduces stress associated with financial transactions and opens doors to better living conditions and personal aspirations. Access to emergency funds or favorable loan terms in times of need becomes much simpler with a healthy credit profile. Conversely, poor credit can lead to higher costs, limited choices, and increased financial strain. Therefore, helping clients achieve good credit is not merely a service, but an empowerment towards a more secure and prosperous future. This holistic view underscores the value of credit repair. Legal framework. FCRA and CRLA. Operating a credit repair business requires a thorough understanding of federal laws designed to protect consumers and regulate the industry. The Fair Credit Reporting Act, FCRA, is paramount, governing how consumer credit information is collected, accessed, and used. It grants consumers rights, such as the right to access their credit report and dispute inaccuracies. The FCRA mandates that credit bureaus and furnishers investigate disputes promptly and accurately. This law provides the legal basis for challenging erroneous information on credit reports, making it central to credit repair operations. Compliance with FCRA ensures fair and accurate reporting practices. The Credit Repair Organizations Act, CROA, specifically regulates credit repair companies, outlining prohibited practices and requiring specific contractual disclosures. CROA aims to prevent deceptive practices within the industry, such as charging upfront fees before services are rendered or making false promises of guaranteed results. It mandates that credit repair organizations provide clients with a written contract detailing services, fees, and the right to cancel. Compliance with both FCRA and CROA is non-negotiable for any legitimate credit repair business. Violations can lead to severe penalties, including fines and legal action, underscoring the importance of strict adherence to these regulations. Ethical considerations in credit repair. Ethical conduct is the cornerstone of a reputable credit repair business. Clients entrust their sensitive financial information and future well-being to these services, making transparency and honesty paramount. Avoiding misleading claims, guaranteeing results, or charging upfront fees for services not yet rendered are critical ethical boundaries. Businesses must always act in the client's best interest, providing realistic expectations and clear communication throughout the process. Building trust and maintaining a strong reputation for integrity will contribute significantly to long-term success. Adhering to ethical guidelines protects both the business and its clients, fostering a sustainable and respected practice. Beyond legal compliance, ethical practices build a strong foundation of trust and credibility within the community. This includes maintaining strict confidentiality of client data, avoiding conflicts of interest, and ensuring all advice is sound and beneficial to the client's financial health. A commitment to ethical standards helps differentiate your business from less scrupulous operators in the industry. It also contributes to positive word-of-mouth referrals, which are invaluable for growth. Upholding the highest ethical standards is not just good business. It is a moral imperative in a field that directly impacts individuals' financial futures. Business models for credit repair. Credit repair businesses can adopt various operational models to suit their resources and target market. Some businesses operate as sole proprietorships, handling all aspects themselves, while others scale up to incorporate teams of credit specialists and administrative staff. A common model involves a subscription-based service, where clients pay a monthly fee for ongoing credit monitoring and dispute services. This provides a steady revenue stream and allows for continuous client engagement. Alternatively, some offer one-time dispute packages for specific items, catering to clients with targeted needs. Each model has unique advantages and requires different operational considerations. Beyond direct client services, credit repair businesses can explore partnership-based models. Collaborating with mortgage brokers, real estate agents, auto dealerships, or financial advisors can generate a significant stream of referral clients. These partnerships create mutually beneficial relationships, expanding your reach without extensive marketing costs. Another model involves offering white-label services to other businesses, allowing them to provide credit repair under their own brand. Choosing the right model depends on your business goals, target audience, and capacity for growth. Diversifying your approach can lead to greater market penetration and resilience. Business planning and structure. A robust business plan is essential for launching and sustaining a credit repair company. This plan should outline your mission, vision, target market, service offerings, marketing strategies, and financial projections. It serves as a roadmap, guiding your decisions and helping you secure funding if needed. A well-articulated plan forces you to think through every aspect of your business, from operational logistics to potential challenges. It provides clarity and direction, ensuring all efforts are aligned with your overarching objectives. Regularly reviewing and updating your business plan is crucial as your company evolves and market conditions change. Deciding on a legal structure, such as a sole proprietorship, LLC, limited liability company, or corporation, is another critical early step as it impacts liability, taxation, and administrative requirements. Each structure has distinct advantages and disadvantages that should be carefully considered based on your business goals and risk tolerance. An LLC, for instance, offers personal liability protection while providing tax flexibility. Consulting with legal and financial professionals is highly recommended during this foundational stage to ensure you choose the structure best suited for your specific circumstances. This decision has long-term implications for your business's legal and financial health. Licensing and registration requirements. Before commencing operations, it is imperative to research and fulfill all applicable licensing and registration requirements. These can vary significantly by state and even local jurisdiction, encompassing general business licenses, specific credit repair organization registrations, and surety bonds. Some states have stringent regulations regarding credit repair services, often requiring substantial bonds to protect consumers. Others may have fewer specific requirements beyond general business licenses, but adherence to federal laws like CROA is always mandatory. Thorough due diligence is essential to avoid legal pitfalls and ensure legitimate operation from day one. Failure to comply with these legal mandates can result in significant fines, legal challenges, and the forced closure of your business. It can also severely damage your reputation and ability to operate ethically. Therefore, diligent research into your specific state and local laws, potentially consulting with a legal professional, is a critical investment. Obtaining all necessary permits and registrations demonstrates your commitment to operating a legitimate and trustworthy business. This proactive approach safeguards your business and builds client confidence, establishing a strong foundation for future growth and success. Developing your service offerings. Defining your credit repair service offerings is vital for attracting and retaining clients. Beyond basic dispute resolution, consider offering a range of services that add value and address various aspects of a client's financial health. These might include credit monitoring, financial literacy education, debt management guidance, or even assistance with building new positive credit lines. Packaging these services into tiered plans can cater to different client needs and budgets, from basic dispute services to comprehensive financial coaching. Clearly articulate what each service entails and the expected outcomes to manage client expectations effectively. A well-defined service portfolio differentiates your business in a competitive market. When developing your offerings, consider the long-term journey of your clients. Credit repair is often the first step towards broader financial wellness. By providing education on budgeting, saving, and responsible credit use, you empower clients to maintain their improved credit and avoid future pitfalls. This holistic approach not only benefits your clients, but also positions your business as a trusted financial partner, rather than just a one-time service provider. Regularly assess market demand and client feedback to refine and expand your service offerings, ensuring they remain relevant and valuable. Innovation in service delivery can also be a key differentiator. Pricing strategies for credit repair. Establishing a competitive yet profitable pricing structure is crucial for your credit repair business. Common strategies include monthly subscription fees, pay-per-deletion models, or flat-fee packages for specific services. When determining your prices, consider your operational costs, the value you provide, and competitor pricing in your market. It is important to balance affordability for clients with the need to cover your expenses and generate a sustainable profit. Researching average industry rates can provide a benchmark. but ultimately, your pricing should reflect your unique value proposition. Clearly defining your pricing model helps attract the right client base. Be mindful of CROA regulations, which strictly prohibit charging upfront fees for services not yet performed. This means you cannot collect payment for credit repair services until those services have been delivered. Transparency in pricing is essential to build client trust and avoid misunderstandings. Clearly communicate all fees, what they cover, and the payment schedule before any agreement is signed. Offering different tiers or packages can provide flexibility for clients while adhering to legal requirements. A well-structured pricing strategy supports both compliance and business growth, ensuring a fair exchange of value. Marketing and client acquisition. Effective marketing is vital for attracting clients to your credit repair business. Develop a multi-channel approach that includes both online and offline strategies to maximize your reach. Digital marketing efforts might involve search engine optimization, SEO, to improve visibility, social media campaigns for engagement, content marketing through informative blogs, and targeted online advertising. These strategies help you connect with potential clients where they spend their time online. A strong online presence is crucial for building credibility and trust in the digital age. Consistent branding across all platforms reinforces your professional image. Offline strategies could include local networking events, partnerships with financial professionals, and community workshops. Collaborating with mortgage brokers, real estate agents, or auto dealerships can generate valuable referral leads. Hosting free educational seminars on credit health can also position you as an expert and attract new clients. Clearly articulate your unique selling proposition, USP, to differentiate your services from competitors. Consistent messaging and a strong brand identity will help build recognition and trust, crucial for client acquisition. A balanced approach combining digital and traditional methods often yields the best results. Building a professional online presence. In today's digital age, a strong online presence is indispensable for any credit repair business. This includes a professional, user-friendly website that clearly outlines your services, pricing, and contact information. The website should be optimized for mobile devices and search engines to ensure discoverability by potential clients. High-quality content, such as informative articles and FAQs, can establish your expertise and build trust. A well-designed website acts as your digital storefront, making a crucial first impression. Ensuring it is easy to navigate and visually appealing is paramount for client engagement. Establishing active profiles on relevant social media platforms allows for direct engagement with potential clients and sharing valuable content. Regular posts, client testimonials, and interactive Q&A sessions can foster a community and demonstrate your responsiveness. Online reviews and testimonials are also crucial for building credibility and trust, as many consumers rely on peer recommendations. Encourage satisfied clients to leave reviews on platforms like Google My Business or Yelp. A well-maintained online presence reinforces your expertise and professionalism, attracting more leads and solidifying your reputation in the competitive credit repair market. Client onboarding and agreement. The client onboarding process is the first critical step in a successful credit repair journey. It involves clearly explaining your services, setting realistic expectations, and gathering all necessary client information. This initial interaction is vital for building rapport and trust, ensuring the client feels understood and supported. A comprehensive client agreement, compliant with CROA, must be signed, detailing the scope of work, fees, payment schedule, and cancellation policies. This agreement protects both the client and your business by establishing clear terms and conditions, preventing future disputes. It serves as a transparent roadmap for the entire credit repair process. Ensure clients understand their rights and responsibilities throughout the process, including their right to cancel the contract within 3 business days. Provide them with copies of all signed documents and a clear explanation of what to expect at each stage. Gathering accurate and complete client information, such as personal details, credit goals, and any relevant documentation, is crucial for effective credit report analysis. A smooth and transparent onboarding experience sets the stage for a productive client relationship, fostering confidence and cooperation. This meticulous approach minimizes misunderstandings and maximizes the chances of successful outcomes. Obtaining credit reports and analysis. The foundation of any credit repair strategy is a thorough analysis of the client's credit reports from all three major bureaus: Equifax, Experian, and TransUnion. Clients are entitled to a free report annually from each bureau, accessible through annualcreditreport.com. It is crucial to obtain all three reports, as information can vary significantly between them, and an item might appear on one report but not another. Once acquired, meticulously review each report for inaccuracies, errors, outdated information, or potentially fraudulent accounts. This detailed analysis helps identify specific items that can be disputed and forms the basis of the credit repair plan. Understanding the nuances of each report is key to effective strategy. During the analysis phase, compare information across all three bureau reports and cross-reference with any documentation provided by the client. Look for discrepancies in personal information, account numbers, balances, payment history, and dates. Pay close attention to items that should have aged off the report, such as bankruptcies after 7 to 10 years or most negative accounts after 7 years. Any inconsistency, no matter how minor, can be a basis for dispute. This comprehensive review ensures no potential dispute opportunities are missed, maximizing the client's chances of credit improvement. Accurate analysis is the cornerstone of successful credit repair. Identifying inaccurate information. Identifying inaccurate, incomplete, or unverifiable information on credit reports is the core function of credit repair. Common errors include incorrect personal details, such as names or addresses, accounts that do not belong to the client, potential identity theft, duplicate accounts listed multiple times, or incorrect payment statuses, accounts that should have aged off the report according to FCRA guidelines. Like most negative items after 7 years, also represent potential disputes. Carefully compare information across all three bureau reports and with client-provided documentation, such as bank statements or loan agreements. Any discrepancy, no matter how minor, can be a basis for dispute, as even small errors can impact a credit score. Training your eye to spot these inconsistencies is a skill developed through practice and a deep understanding of credit reporting standards. Look for inconsistencies in dates, balances, account numbers, and status codes. Sometimes, an account may be legitimate but reported incorrectly, such as a late payment marked as a charge-off. It is also important to identify accounts that are unverifiable, meaning the data furnisher cannot provide sufficient proof of their legitimacy. These types of errors are prime targets for dispute letters, as the bureaus are legally obligated to remove information that cannot be verified. Thorough identification is the first step towards successful removal. Crafting dispute letters effectively. Dispute letters are formal communications sent to credit bureaus and creditors to challenge inaccurate information. These letters must be clear, concise, and professional, specifically identifying the disputed item and explaining why it is inaccurate or unverifiable. Avoid emotional language or irrelevant details. Stick to the facts and legal basis for your dispute. Include supporting documentation, if available, such as proof of payment or identity theft reports, but avoid overwhelming the recipient with unnecessary information. Each letter should be tailored to the specific inaccuracy and sent via certified mail with a return receipt requested, providing proof of mailing and delivery. Effective letter writing is a critical skill for successful credit repair outcomes, directly impacting the Bureau's investigation. There are different types of dispute letters, including initial dispute letters, debt validation requests, and follow-up letters. Understanding when to use each type is crucial. For instance, a debt validation letter is sent to a debt collector, while a direct dispute letter goes to the original creditor. Always retain copies of all sent letters and supporting documents for your records. The tone should be firm, yet respectful, asserting the client's rights under the FCRA. A well-crafted dispute letter clearly communicates the issue and demands a thorough investigation, setting the stage for potential removal of negative items. Precision and adherence to legal guidelines are paramount. Sending disputes to bureaus and creditors. Once dispute letters are meticulously crafted, they must be sent to the appropriate parties, the credit bureaus, Equifax, Experian, TransUnion, and, in some cases, the original creditor or data furnisher. Sending letters via certified mail with a return receipt is highly recommended. This provides undeniable proof that the letters were sent and received, which is crucial if further legal action becomes necessary. The return receipt serves as official documentation of delivery, which can be invaluable in proving compliance or non-compliance by the bureaus or creditors. Always send disputes to each bureau separately, even if the same item appears on all three reports, as they operate independently. Following up and tracking progress. The dispute process does not end with sending letters. Diligent follow-up and meticulous tracking are essential. Credit bureaus typically have 30 to 45 days to investigate disputes and respond. It is crucial to monitor this timeline and follow up promptly if no response is received within the statutory period. Maintain a detailed tracking system for each client, noting every dispute sent, the date, the bureau creditor, and the outcome. This system helps manage multiple client cases efficiently and provides a clear audit trail. Effective tracking allows you to quickly identify stalled disputes or those requiring further action, ensuring no client falls through the cracks. Regular communication with clients about their case status is also vital for managing expectations and maintaining trust. Provide updates on received responses, explain the next steps, and clarify any complex terminology. If a dispute is denied, analyze the reason for denial and strategize the next course of action, which might involve sending a more detailed letter or requesting further validation. Persistence is key in credit repair. As some items may require multiple dispute attempts, a well-organized follow-up and tracking system is the backbone of an efficient and successful credit repair operation, demonstrating professionalism and commitment to client results. Dealing with collections and charge-offs. Collections and charge-offs are highly damaging items on a credit report, indicating severe delinquency and often leading to significant drops in credit scores. When dealing with these, strategies may include debt validation, pay-for-delete negotiations, or simply disputing inaccuracies if the information is incorrect. Debt validation involves requesting the collector to prove the debt is legitimate and that they have the legal right to collect it, a crucial step, especially for older or unfamiliar debts. This can be a powerful tool if the collector cannot provide sufficient documentation, leading to removal of the item. Understanding the nuances of these items is critical for effective resolution. Pay for delete is a negotiation tactic where the client agrees to pay a portion of the debt in exchange for the collection agency removing the item from their credit report. This must be secured in writing before any payment is made, as verbal agreements are often not honored. While not all collectors agree to pay for delete, it is a viable strategy for some. Careful consideration and strategic communication are required for these complex situations. Always advising clients on the potential impact of any agreement on their credit and finances. Sometimes, simply disputing the accuracy or verifiability of the collection can also lead to its removal. Each case requires a tailored approach. Understanding debt validation. Debt validation is a consumer right under the Fair Debt Collection Practices Act, FDCPA, allowing individuals to request that a debt collector provide proof that a debt is legitimate and that they have the legal right to collect it. This is particularly useful for older debts or those sold multiple times, where documentation may be incomplete or inaccurate. Sending a debt validation letter within 30 days of initial contact from a collector is crucial to invoke this right effectively. The collector must then cease collection activities until they provide proper validation. This pause in collection efforts can provide valuable breathing room for clients. If the collector cannot validate the debt, they must cease collection activities and remove the item from the credit report. This strategy can be a powerful tool in credit repair, especially when dealing with aggressive or uncooperative collectors. A validation request forces the collector to substantiate their claim, often revealing gaps in their documentation. It is important to send these letters via certified mail with a return receipt to prove timely delivery. Educating clients on their FDCPA rights empowers them to challenge questionable debts and protect themselves from unfair collection practices. This proactive approach can lead to the removal of unsubstantiated negative items. Building positive credit history. Beyond removing negative items, a comprehensive credit repair strategy includes actively building positive credit history. This involves advising clients on responsible credit behaviors, such as making all payments on time, keeping credit utilization low, ideally below 30% of available credit, and diversifying their credit mix. Consistent on-time payments are the most significant factor in building a strong credit score. Educate clients on how to manage their existing accounts responsibly and avoid new debt that could jeopardize their progress. This proactive approach ensures that once negative items are removed, positive habits take their place, leading to sustained improvement. Suggesting secured credit cards, credit builder loans, or becoming an authorized user on a trusted individual's account can help establish new positive accounts. Secured credit cards require a deposit, acting as collateral, making them accessible to those with poor credit. Credit builder loans are designed specifically to help establish payment history. Becoming an authorized user on an account with a long positive history can also boost a client's score, provided the primary account holder maintains good standing. Emphasize the importance of long-term financial discipline. Building positive credit is a proactive step that complements dispute resolution, leading to a stronger, more resilient credit profile over time. Credit monitoring and maintenance. Credit repair is not a one-time event. It requires ongoing monitoring and maintenance to sustain the improvements achieved. Educate clients on the importance of regularly checking their credit reports for new inaccuracies or fraudulent activity, as errors can reappear or new ones can emerge. Encourage them to subscribe to credit monitoring services that alert them to significant changes, such as new accounts opened, inquiries, or changes in credit limits. These services provide an early warning system against potential identity theft or new reporting errors. Proactive monitoring helps clients protect their improved credit profile. Provide guidance on maintaining healthy credit habits post-repair, ensuring they continue to make timely payments and manage their credit responsibly. This includes budgeting, avoiding excessive debt, and understanding the impact of new credit applications. Offering post-repair support or a maintenance plan can be a valuable ongoing service for your business, helping clients sustain their improved credit profiles. This recurring service not only provides continued value to clients, but also creates a stable revenue stream for your business. Emphasize that credit health is a journey, not a destination, requiring continuous vigilance and responsible financial behavior. Client communication and education. Effective communication and client education are paramount throughout the credit repair process. Regularly update clients on the status of their disputes, explain any changes to their credit report, and clarify complex credit concepts in an understandable manner. Use clear, jargon-free language to ensure clients grasp the intricacies of credit reporting and dispute resolution. Provide resources and guidance on financial literacy, budgeting, and responsible credit management to empower them to make informed decisions. This educational component transforms clients from passive recipients of service into active participants in their financial journey. Transparent and empathetic communication builds trust and reduces anxiety. Foster a supportive environment where clients feel comfortable asking questions and expressing concerns. Regular check-ins, whether via email, phone, or a client portal, demonstrate your commitment to their success. Beyond just fixing credit, your role involves coaching clients towards better financial habits that will serve them long after your services conclude. A well-informed client is more likely to adhere to advice and achieve lasting credit improvement, becoming an advocate for your business. This holistic approach to client engagement not only improves outcomes, but also strengthens your business's reputation and client loyalty. Scaling your credit repair business. Once your credit repair business is established and running efficiently, consider strategies for scaling to reach a wider audience and increase profitability. This might involve automating parts of the dispute process using specialized software, hiring and training additional staff to handle increased client volume, or expanding your service offerings to include more advanced financial coaching. Automation can significantly reduce manual workload, allowing your team to focus on more complex cases and client interactions. Investing in robust infrastructure is key to handling growth without compromising service quality. Strategic growth requires careful planning and investment in technology and human capital. Implementing robust CRM, customer relationship management software, can streamline client management, communication, and tracking, making it easier to manage a larger client base. Exploring white label partnerships or affiliate programs with other financial service providers, such as mortgage lenders or real estate agents, can also generate new revenue streams and expand your market reach. These partnerships allow you to leverage existing client bases without direct marketing efforts. Diversifying your income streams and optimizing operational efficiency are crucial for sustainable scaling. Continuously evaluate your processes and adapt to market demands to ensure long-term success and continued expansion. Maintaining compliance and best practices. Ongoing compliance with federal and state regulations is crucial for the long-term viability of your credit repair business. Regularly review and update your contracts, disclosures, and operational procedures to reflect any changes in laws like FCRA, CROA, and FDCPA. The regulatory landscape can evolve, and staying informed is paramount to avoid legal issues and penalties. Implement robust data security measures to protect sensitive client information, adhering to privacy regulations such as the Gramm-Leach-Bliley Act. Protecting client data is not only a legal requirement, but also a fundamental aspect of building trust and maintaining your reputation. A breach can be devastating for a business. Adopting industry best practices, such as maintaining clear and accurate records for all client interactions and disputes, providing realistic expectations, and offering excellent customer service, reinforces your reputation and minimizes legal risks. Transparency in all dealings, from pricing to dispute outcomes, is non-negotiable. Continuous education on regulatory changes and industry trends is paramount for sustained success and ethical operation. Participating in industry associations and professional development programs can help you stay informed and connected. A commitment to compliance and best practices ensures your business operates ethically, legally, and sustainably, fostering long-term client relationships and a strong market standing. Future trends in credit repair. The credit repair industry is constantly evolving, influenced by technological advancements and changes in consumer behavior. Future trends may include increased integration of AI and machine learning for more efficient data analysis and dispute generation. AI-powered tools could automate the identification of inaccuracies and even draft initial dispute letters, significantly speeding up the process. This technological shift will allow credit repair professionals to focus more on complex cases and personalized client coaching, rather than repetitive administrative tasks. Embracing these innovations will be crucial for businesses looking to maintain a competitive edge and enhance service delivery. The rise of financial technology fintech platforms could offer new tools and partnerships, creating a more interconnected ecosystem for financial wellness. Furthermore, a greater emphasis on financial wellness and holistic financial coaching, rather than just dispute resolution, is likely to emerge. Clients will seek comprehensive guidance on budgeting, saving, and investment, viewing credit repair as part of a larger financial journey. Staying abreast of these trends and adapting your business model will be essential for remaining competitive and relevant in the years to come. Continuous learning and strategic adaptation are key to navigating the future landscape of credit repair.